as the popularity of profitability and other types of factor characteristics have come to light by leading academics, one of the largest debates recently has been over how you assess quality or profitability in stocks and how they relate to asset allocation. And we have with us today Wes Crill, experienced research veteran for Dimensional Fund Advisors. And Wes, can you kind of give us an overview of what's going on in this sort of analysis?
Yeah, the profitability discussion kind of takes me back to my early days at Dimensional, because the research we were doing, back then around a really seminal paper from Robert Novi Marx was happening in my early days with the firm. So it's near and dear to my heart is a long way of saying that. But, with profitability, the idea is you would identify companies that had strong levels of earnings, and you could use that information along with the valuations to then say, okay, companies with high expected future cash flows for a given price have higher expected returns. It was a way to get further insights about differences in expected returns among stocks. Now, there's many different ways you could define profitability, and there's many different items you might take or exclude from the income statement. And so whenever we're doing research like this, whether it's profitability, whether it's relative price, we study lots of different variations on these variables. And you're not looking necessarily for which ones perform the best historically. In fact, you kind of want to make sure that they're relatively insensitive to differences in specification to make sure they're robust, which we do see with profitability. But you're also looking at other characteristics. So what's the level of turnover I have for using different variables? What are the trade-offs when it comes to asset allocation? Do I get any unintended consequences when I make changes? And I think this is an important distinction when it comes to profitability, which is our measure, compared to quality, because quality tends to have different variations, but it tends to have multiple metrics associated with it. So, for example, there might be something that is earnings-based, like return on assets, but oftentimes it's combined with other variables such as leverage, such as volatility of earnings. And what we see in the data is that when you combine those different variables together, you have trade-offs among those different measures that ultimately lead the quality type strategies to have what I would say are some confounding exposures for their asset allocation. And in particular, they oftentimes will hold some value stocks with low profitability. So if I think about what is the goal for a high profitability portfolio or exposure to high profitability stocks, I might be trying to complement value exposure in my asset allocation. Well, quality approaches don't tend to fare as well along those lines because they do tend to also hold some value. So you might end up doubling down on your value exposure, which might not be your intention. So again, this is part of the process that we have when we're evaluating really any premium, but certainly it's come up with profitability versus quality.
And then when you look at asset allocation in your portfolios, doesn't value go better together with the value factor and value characteristics? So you're just getting more specific, correct, than generic quality assessment?
I think that's probably one way to describe it. So high profitability allows you to more effectively target high profitability stocks, as the name would suggest. But specifically what we're looking for here is what provides a reliable complement to value to the extent that our clients are trying to satisfy that objective. And again, that is a drawback with quality type of approaches where they might have more overlap with value. And so if you're looking to come up with a set of stocks or a set of exposures that will complement the return behavior of value. Again, that's one of the big benefits here is these premiums don't necessarily move in lockstep. Over the past 3 to 5 years, when value stocks were underperforming growth stocks in the US, high profitability stocks were outperforming and the premium was delivering a good experience for investors. So they had a nice balancing act there where you might leave some of that on the table if you have a measure of profitability that is combining other variables and is not as laser focused on that segment of the market.
Yeah, I know some investors like to split it down the middle. Profitability, 50% profitability, 50% value, throw in some small cap coverage. But DFA takes a more nuanced approach, correct?
We think there's different ways to go about that have trade-offs. It kind of depends on what your ultimate goal is. So you can use all these concepts together, whether it's profitability exposure or value exposure. You can do that within one portfolio that would just take systematic over and underweights to stocks based on both their profitability and value characteristics simultaneously. But then to your point, another way you can do it is to divide up the market, and you can have asset class portfolios. Maybe one is focused on value, which means that it might not hold many of the high profitability stocks out there. And then you might combine that with a high profitability portfolio, which, as the name suggests, is focused on high profitability stocks, but tends to hold growthier stocks as well. And by combining those in different ways, you can affect whatever asset allocation or whatever tilt you want versus the market. So there's different ways of doing it, but the key aspect here is it needs to be delivering on whatever the stated intent is. And I think having a specific focus on high profitability, using that measure of profitability rather than quality, gives more reliable results for either one of those objectives.
Sure. Okay, well, thank you very much, Wes.
Yeah, my pleasure.